Welcome to Macro Hive Conversations with Bilal Hafiz. We aim to bring you the best in macro and markets thinking. To see our latest thoughts and analysis on the world, visit macrohive.com. There's so much happening in the world right now. Growing US-China tensions, better US labour market data, and so more talk of V-shaped recoveries. The European Union turning a corner with a recovery fund. We touch on many of these this week on our Macro Hive site or our Slack channel. Notably, we summarised some academic work on how US COVID fiscal measures could slow a US labour market recovery, and then wrote on how to fix that problem. We had a great piece on Germany's Merkel's moment in history to save the EU. We featured a piece on how high government debt can be sustainable, and we also had an interesting angle on COVID social bonds. You can access all of this for the price of a weekly cinema ticket, so sign up, you're not going to the cinema anytime soon. Onto our podcast show, we have Emiel Van Den Heiligenberg, who's the head of asset allocation at Legal & General, one of the world's largest asset managers. He's actually one of the top portfolio managers that I know. His fund has been a top quartile performer over the last 5 years, and his fund is one of the fastest growing multi-asset funds out there. But what I like about Emiel the most is what he does outside of work. He used to be a rower, but admits himself that French fries got the better of him. Now he makes do with shark diving and skiing. And this background has actually led him to think a lot about how to manage teams for maximum performance. We touch on this as well as talking markets on our podcast. So onto our conversation. Welcome, Emiel, to the podcast. I thought we'd jump straight in and get your opinion on how you're seeing the world right now, your kind of current outlook, and what you think of the rally that we've been seeing in many risk markets over the past month or so.
Well, I think the rally is very, very frustrating. If you think about it, why we've rallied, clearly a short squeeze, clearly central banks have gone all in, and yes, they've taken out, I think, systemic risks. We've seen, I guess, some encouraging news on the virus. If you look at it, opening up of economies like in China, Korea, or even Germany and Italy is probably better than people feared. And then some news on the vaccine as well. I'll come to that later. And then lastly, and that's probably the part where it's frustrating, markets are so momentum following at the moment. There's, I guess, so much money following quantitative momentum kind of stuff. And there's probably not a lot of fundamental money at the moment which is moving around. So that's really is moving prices on low volume. If you think about risk assets, then you should probably separate it into equities and credits. If I start with equities, I think that if you believe current market levels, then you should assume four things. So one is there won't be any significant second waves of infections. Second, the opening up of the economy goes well. So people come back, people actually start to consume again, and so on. And then thirdly, there won't be any sort of permanent scarring. And then lastly, a vaccine is found and is effective probably within the next 12 months. We think all four are possible, but all four are quite uncertain and unlikely. Therefore, the combination of the four is where we say, well, okay, that seems like quite a lot of optimism priced. If you then think about the vaccine, yes, so optimists, which I also in my team, optimists will say there's a lot of government backing, plus more than 100 initiatives with lots of money behind it to find a vaccine. True, but if you can establish a base rate here, then the speed record of developing a proper vaccine is 4 years, I'm told. We think we can do this now in 12 to 18 months. Only a small percentage of clinical trials leads to a medicine. So optimism on one company announcing phase 2 trial, I mean, that feels bonkers to me in a way. And then there have never been vaccines for the 8 corona type of viruses we've seen before. So base rate is not in your favor, but you've got so much research going on that people and market address optimism to that. On the economic side, well, let's kill the economic debate immediately by saying there is a high degree of uncertainty. Whether it's a V, whether it's a U, whether it's a W, who really knows? But the data in the beginning, like we are in the phase now, is all the same. You get a catastrophic downturn, and then you get an initial recovery. And we see sort of the first signs of that recovery. But I don't get how people that really conclude from the data whether we are V, U, or W. So that's weird to me. And it obviously reveals my position, but I feel that we're going to end up in a sort of balance sheet recession. Either people and companies will try to restore savings rates or leverage or build some buffers in. So that's on the economic side. Earnings modeling is very, very difficult in these things. Everyone's earnings models are based on normal economic growth patterns. At best, probably -1 on GDP growth to +4, +5. So now you have to do your modeling on, at least macro modeling, on really unprecedented GDP kind of impacts. But we've tried to cross-check it with our equity teams and with the bottom-up analysts. And we think earnings should go down -14, -50%. And we are not there yet.
I think investors currently are expecting down around 20%, I think, is what's currently priced, I think, in terms of earnings at least.
30, but yeah.
30, okay, yeah. So around that sort of ballpark. Yeah, so there's more scope for downward revisions from your analysis.
And then if you plug in 12 months out earnings, then markets are very expensive. But if you plug in, let's say, 18 to 2 years out earnings, then I still think markets are quite expensive. And there's obviously a lot of uncertainty about that. I get that. But that means we're cautious around equities. We would try to lean against this rally, but that also then reveals my frustration because that hasn't been the right position to be in.
And just on the multiples, equities are trading expensive to earnings. How do you put into the equation the level of yields? Because obviously the discount rate, yields have fallen as well. So some people argue that low real yields should allow higher PE multiples, because discount rate's gone down. How do you kind of think about that in terms of valuations?
That's one side of the argument. If you would take a chart and plot either real yields or nominal yields and PE levels, then usually sort of if yields get really close to zero, then actually, or at really lower levels, then actually the base rate again is actually for lower PEs. Longer term, if we go in a world or go back to the world where it's low growth, low inflation, low volatility of growth, low volatility of inflation, then equity valuation is going to be bid up. But I think that's way more an argument of where you would expect equity valuations to be in 5 years' time rather than why it would really price the market at the moment. I mean, where we take risk, we prefer credit risk over equity risk. I would assume that's a reasonable consensus trade. It's so much central bank money behind it. There's so much support. So especially if you can sort of create leverage, then I would say equity risk is less attractive than credit risk because of that support. And we see that in investment grade, high yield, and to some extent emerging market debts as well. That's more or less how we'd look at the risk trade.
And in terms of in the credit space, are you making any differentiation between the US and Europe, or do you kind of put them in the same sort of bucket? Because I guess now you do have the Fed supporting credit as well.
Because European spreads were always still a bit on the tight side. When we took this decision, we were lucky enough to sort of increase that on the US side. And I still think they are probably still slightly more attractive on the US side than on the European side.
And one thing some people have talked about is cash on the sidelines, and you're obviously at one of the largest asset managers in the world. Do you find that that's the case? There is cash on the sidelines that's ready to be invested. You mentioned earlier that there's lots of quant money, systematic money that's just piling into the market at the moment. What's your kind of sense of that dynamic?
This time with market volatility, and I think it's actually in the process, it's a good way of improving your process, continuously improving your process as we look back a lot. We spent relatively quite a lot of time in doing, in a way, post-mortems. Doesn't have to be, doesn't have to be finished, but sort of like, what can we learn from the last 3 months? So basically it's obviously with the benefit of hindsight, what we should have realized end of March, that sentiment was overdone, and we should have been more aggressive in trying to buy risk in that. But the second thing, which is probably more process way, is I still think that's either cash on the sideline, or if you look at positioning indicators or you look at sentiment, what I try to do is when I talk or read or listen or look at tweets, I try to sort of keep track of how many people tell me a day whether I should buy or sell equities and see that as a contrarian. And I still think that the market is still cautious. Institutional money is still on the cautious side. If that's the case, then there is still upside, because then if the CTAs of this world continue to put money in, then at some point FOMO starts to apply for fundamental money as well. Then people just start to buy into carry trades, risk trades, and so on. So that is, if you say lean against the market, which we really try to do, the risk of that position is that I think that we are not the only one in that positioning. Every trader knows that you can only hold on to a negative carry or a negative risk trade for so long.
Yeah, I guess people mean different things by recovery trades. But in your view, what would be the ultimate recovery trade?
A couple of things. So obviously trying to lean against the market, we need to think about, okay, what could help us if we are wrong? How do we balance that position? I think a couple of observations. One is technology. So we are positive tech. We're going to be in an environment where there's low nominal growth, high debt levels. First years, we would argue, of low inflation, then possibly very high inflation. But a continuation of the digital Industrial Revolution. And anecdotal evidence is even my parents-in-law, which are in their 80s, now order groceries online and are using Zoom calls and what have you. So they've become suddenly way more digital than they've been in the past. Continuous pressure on trade and supply lines, and then the geopolitical environment, the existential fight in a way between the US and China, will mean that technology and national technology industries and AI, for instance, is getting increasingly important. I mean, Putin mentioned once that the nation which leads in AI will be the ruler of the world. So people would tell me, if we say we're positive on tech, people always push back and say, don't you expect tech regulation and so on? And Trump tweeted today around possibly regulation. The big picture of thing is the countries will have a massive interest in developing their own technology and making sure that they are sort of on the forefront of tech, and cannot afford in a way to completely regulate the creative power of that tech industry away. So if you think about that environment, about growth, pricing power, in a way, simplicity of supply chains, then I think that's almost like a perfect environment for tech. We've been long tech for a long time, but I don't think we should think about profit taking there. Almost on the contrary, we would probably buy on dips.
And the best way to position for tech, would that just be through investing in tech equities, or is there some other asset classes that you could look at as well?
I'm a macro investor. I try to not think about too much individual company risk, then it all gets mixed up. So we either would ask one of our equity managers to manage tech for us, but at the moment it's simply a NASDAQ future versus an S&P future, for instance. And the second one is, the ultimate one is, in equities there are some sectors in a way, or some themes, like value, small caps, cyclical stocks, and auto companies, which no one likes. Well, it starts to come now. But for the last 5-6 years, no one likes small caps, no one likes value, and energy as well. And we say, well, if we are wrong on our assessment on the virus and on the economy and on the scarring of the economy, and therefore that you should sort of start to sell this rally, then it must be that the next phase of this rally is in the laggards. And if you're right, then I think the laggards have sold off already so much that it doesn't give you an absolute downside protection, but I do think there's an interesting asymmetry in that trade.
So the two core kind of recovery trades, so to speak, one would be tech, and then the other would be these laggards that have really struggled in recent years and also in recent months as well.
Which is more tactical, I think. Would you own energy for the long run? Probably not. Would you own value for the long run? Not convinced, but value comes out of a period where it did already badly for the last 5-6 years, and then did even exponentially bad in the sell-off. If people now start to buy into it, especially people which are skeptical and are drawn into it by momentum, I would argue then it's a natural thing to say, well, I'm probably too late to buy into the expensive stuff. Where can I allocate money where I might not be too late? And then these sectors are probably interesting.
You mentioned earlier about sort of geopolitics and US-China tensions. Over the past few weeks, we're seeing more noise between US and China. I mean, how do you bring that into the investment process?
I think we share a common interest here, Bilal. I listened to your podcast, and you mentioned the books you read recently, the one of Howie and Strauss.
The Fourth Turning.
They talk about sort of long-term cycles. I was educated by Kondratyev cycles, which I think is more or less the same. What struck me when I listened to your podcast is you took the positive interpretation of that one, which was that we are sort of close to the end of the fourth turning, and the fourth turning is in a way the crisis. There probably I would disagree, or I'm afraid that we are probably at the beginning, my view. And this is driven by what historians call Thucydides trap, so the after Peloponnesian wars between Sparta and Athens. What happens is you have a ruling power, in this case Sparta, and is challenged by an upcoming power, which at that point was Athens, simply because of the threat which a new upcoming power is towards the ruling power. You get massive geopolitical tension. And Harvard Kennedy School have done intriguing research where they identified 16 periods in history, starting in the 15th century, which have sort of equivalent kind of circumstances, where you have an upcoming power and a ruling power. And the depressing conclusion is that only in 25% of these cases, so in 4 of the 16, a war has been avoided. And then when I talk about this with the team or with other people, then people say, well, surely, but we currently have nuclear powers, and it's very, very clear for everyone that if there is a conflict, then you're very close to self-destruction as well. Not only sort of achieving your political goals, but also self-destruction. I have the sympathy for that, and I hope that must be true. But I've also done some digging, and since the 50s, there have been 13 recorded incidents, which they call a nuclear close call, where something happened and a use of nuclear weapons was really close by. So you cannot be too optimistic. Now, we're going really on the dark side. But if you then bring it back to now, we've got trade war with the US and China. I think you should see that definitely in the background of existential fight between the US and China. And I don't think that the coronavirus made it any easier or better. It started with Trump repeatedly talking about the China virus, and it started with China trying to blame the US military for the outbreak, and the rest is history. US then contemplating of making Chinese stocks in the US more difficult, and so on and so forth. I mean, that are all sort of in a way shots in that conflict. And then we go to US elections. I think Trump sees a tough stance on China, and I think he's right, as something where he can gain votes and attack Biden. And that will mean it will remain on the forefront of the debate, and might even mean that Biden will become more critical than he was originally intending to China as well. After the elections, I think public opinion in the US is hardening towards China. So I don't think even the elections would give a lot of relief or support there as well. How do you bring that back to portfolios? So high level, I think it increases the value of regional diversification. It increased the value of foreign currency exposure again, and trying to diversify foreign currency exposure there. It obviously slows down trends which are already in place and in train, like globalization. And the more difficult thing to price is probably sort of like Trump is already eroding the value of institutions, whether it's the World Bank or even NATO. And so this is continuing by this isolationist attitude as well. Related to that, if we get a vaccine, it's really interesting to sort of see what's happening then. No? And you have noises of pharmaceutical companies who say, whatever, we're going to roll out the vaccine first in the US and so on. India, who is a producer of medicine, would say, well, if we produce it in India, means that our population should get first. It might be far-fetched, but if you see the virus as an attack, where people talk about the virus as an attack occasionally. If the US would demand, whatever, the first 100 million of vaccines, would that be a problem for NATO?
Yeah. I mean, it opens up sort of Pandora's box almost. I mean, it brings all sorts of questions to the surface. You know, do you break commercial agreements that you have already to protect your own population? Does that then lead to breakups of existing treaties, then potential conflict, military conflict? And even getting a vaccine may not necessarily be the big panacea to solve all problems necessarily. It could actually lead to many more problems.
Especially because they won't be available immediately for the entire world population. There are a few people talking about, should this become available for free for everyone, to open up there's a no patent kind of solution. Related to that, if I may, there's a very interesting research from New York Fed about the Spanish flu and impact on German voting patterns. So what they've done is looked at every municipality in Germany, and they measured the number of deaths in those municipalities. And what they found was that in the 10 years afterwards, those municipalities with that relatively lots of deaths had a significant shift in vote share towards the extreme right. If you think about that, history won't repeat itself, but it might look like it. If that's the case, Italy is already a relatively large extreme right party. That if we get another move towards the right in Europe, that's probably the last thing which we need.
When it comes to Europe and even the US as well, I mean, how do you see the longer term effects of the COVID impact on, say, the economy? So you've mentioned some of the political consequences, and we've talked about some of the near-term market dynamics. But in terms of, as you said earlier, sort of scarring or permanent scarring of the economy, what do you mean by that, and who will suffer the most?
I'm probably most bearish Europe, but that has way more to do with the political situation, the fragmentation in Europe, the constant trade-off between European Union and national interest. Probably also the risk of a move to the right in Europe, where in the US we already have Trump, which is not exactly to the right, but it's it's definitely quite a populist kind of leader.
But what do you make of the recent talk about the EU recovery fund? So, markets seem to have responded positively positively to that news. Italian spreads have narrowed, the euro's gone up.
I agree with the market move. So I don't think there's a trade in that. I was surprised. I was positive surprised. We definitely didn't expect Merkel to make that move. There's still some holdouts. The Netherlands, for instance, is a holdout. And part of the sort of political situation, if you think about the national political situations, then you understand why the Netherlands is the holdout. I'm pretty sure with Premier Rutte is a moderate right person. I'm pretty sure that he wants to stay in the European Union. He doesn't want tensions to build up. He even is probably prepared to grant Italy or periphery or whoever needs lots of money if that guarantees European Union to continue. Can he sell that to his voters? Can he therefore fight off more right-wing and more anti-European parties which are gaining votes? That's his problem. I think in ultimo, Northern European countries which are critical will decide pro-European Union. But usually it needs a crisis before we take a step forward. So that's probably what's so surprising around the Merkel turn, that it didn't need Italian spreads to go to 450 before he did it.
And it's interesting the Dutch and the so-called frugal four, Netherlands, Denmark, Austria and Sweden. So it's going to be more complicated than simply Merkel giving Rutte a call and saying, you have to be on board. There's something else that needs to happen within Netherlands, I guess, itself. There's like a domestic support that needs to be given. It can't just be kept at the executive level. That's a challenge.
And that's been a weakness of Europe as well. Now, selling Europe. It's a very popular phenomenon in the UK, but in all other countries as well, is to take credit for everything which goes right and everything which goes wrong, blame that on the European Union. I mean, that's sort of a basic strategy, basic politics 101. But that means now no one really likes it. Everyone has the impression that there are bureaucrats who, and they are to some extent, bureaucrats which are not voted in or don't have any democratic legalities. And we've done that ourselves a little bit in the making. I don't know how to get out of that. But what I think the strategy will be is we are also into new EU budget negotiations. It's pretty likely that, for instance, the Netherlands will be attacked on our liberal tax regime for holding companies, for instance, or try to find some leverage in those negotiations around budget and so on to create votes. I would say if France and Germany are firmly behind it, then in the end, something like that gets done. You asked me about scarring of the economy. That's where our more bearish view probably comes from. I think companies have gone through a confidence shock and through a liquidity shock. Lots of companies are taking on way more debt. Companies are getting downgraded or are at the risk of downgrades. That means first step will be balance sheet repair. The city, once people start to return to their desks, once situations start to normalize, I would expect most of the bigger companies to say, well, okay, we're behind budget, we're behind, and we need to start to do some cost cutting. And by the way, working from home has shown that we have some excess capacity in the system. We can actually get rid of part of our staff. So that's on that side. If you then think about it on the consumer side, many people are behind their mortgage or are not paying rent or are paying less rent or are living on a system which is in the end supported by the government. Yes, if the economy opens up, I think there will be some, I thought a nice word, revenge spending. And so people, I'm getting back to the virus, I'm going to sort of treat myself to a nice restaurant or whatever because of that. But in the end, I think that first pent-up demand will drop back into more cautiousness and sort of like similar-ish to a sort of balance sheet recession. We've seen echoes of that from in Japan. Evidence is mixed so far. This morning, my economist showed me some credit card data out of the US and it was way better than expected. But if you look to data from Georgia, which is one of the first states to reopen, it is interesting that sort of after a first uptick of that revenge spending, the demand quickly evaporated. I think that is clearly where the scarring shows itself. And then you have scarring obviously around defaults and delinquencies on credit card debt and so on, which makes it difficult as well. Two interesting surveys to mention, or two interesting data points to mention. Barclays had done a summary of the earnings calls recently, and they said one of the underlying themes was that CapEx is going to be slashed massively. And then the BAML fund management survey, which is, I think most of our listeners will know. I thought it was interesting to see that what investors want companies to do is also balance sheet repair. I have to check whether that happened in 2008 as well. But that was a long time that I see that as the highest demand what companies needed to do, where it was buying back shares in the past and so on. Now it's balance sheet repair.
No, that's definitely interesting. And as you kind of said at the beginning of the call, we're kind of at the first bit of the bounce from the bottom. And so it's really hard to tell whether we're in the V, the U, the W, because obviously everything should just go up right now. But what you don't know is if it's short-lived or not. And that research you mentioned on George is very interesting.
I mean, I cannot prove it's a U. My view, it's going to be a U, but I don't understand why people who think it's way more like a V shape, where they get their confidence from. That's hopes rather than data, in my view. That's not a good investment strategy.
And do you have a kind of a view on the US reopening and chances of second waves and just how that whole process has unfolded?
Yeah, we did some research on that. If you look at the US as a whole, then it's following the pattern of China and Italy and to some extent the UK as well. Meaning first signs of reopening are when the number of new cases or the number of hospital admissions are going down. However, if you exclude New York and New Jersey from that, because they were very early and then they started lockdown way earlier, then the rest of the US is actually is not in that phase. So it looks like that the US is opening up earlier than China and Italy, for instance. And social distancing, it might not be as strict as it, for instance, is in the UK as well. It makes me worried about a second wave risk in the US. But having said that, we also done research based on lots of academic research on what are the measures you can take to reduce R0. And there are obviously lots of contact measures you can take. I mean, social distancing, elimination of big events, not using public transport anymore. That all has an economic impact. We understand that if we don't use the tube and if we don't go to work, restaurants are not opening, then that has immediate economic impact. What's interesting is there are also several measures you can take don't have necessarily immediate direct economic impact, like hygiene, masks, tracing app, and massive amount of testing. And we try to see in different academic research on what could you reduce R0 towards 1 if you would do all those non-contact measures really strict. We think the answer is yes. So that means if you have a tracing app in place, which is used by the population, if you have massive testing in place, antibody and for the actual virus. And if people use masks like they would use in China, so with at least sort of a 75% adoption rate, wash their hands, which I think everyone will do probably, but then I think it's pretty likely that you can control the virus. And that would mean that if you do that long enough, I think then behavior could start to normalize, and even more vulnerable people would say, well, there are now so few cases in society, I'll feel a bit more comfortable in participating in social life again as well. We will be in that situation where we slowly but gradually think we can keep this under control by doing that.
And in terms of your current favorite positions, trade ideas, investments, do you have some that you gravitate towards or you sort of like the most?
I mentioned before on the equity trades already. For your audience, probably a popular trade. We like gold as well. I think the end game is helicopter money. And I think the genie is out of the bottle with combining monetary policy and fiscal policy. People were reluctant 1-2 years ago to stimulate the economy in a fiscal way. That's completely gone. And once politicians taste their own medicine and see how easy it is to chase your own political agenda, that it will be very hard to stop. And central banks could stop it at some point, of course, by saying, well, okay, you can continue, but we won't help financing it anymore. But I think even that is very hard for central banks to do, given political pressures on them to keep interest rates low. So I think gold should fit in many, many portfolios.
Do you think many asset managers position in gold or not? Because I know hedge funds can and do, but large asset managers, do you think they are sort of positioned in gold?
No, I don't think so. I think, by the way, at the moment, it's not always the case, but at the moment, you could proxy gold if you have regulatory problems of buying commodities directly. You can, at the moment, proxy gold reasonably well by buying gold miners. The correlation between the commodity and gold miners has in the past not always been that good, and it depends quite a bit on the hedging policy miners have and so on. But I think the correlation has been tight enough to use it as a reasonable proxy, which makes it probably more accessible for some of the institutional investors. And then inflation. I think inflation is interesting. I think long-term inflation in the US and in Europe is cheap, even though it curves pricing deflation short-term, and I agree with that. but long term you can pick up 15 years inflation in the US at way below targets, which I think is a cheap trade to hold.
And that would be a US trade rather than a Europe one.
I would probably own a little bit of European inflation as well. Where I would short inflation is in the UK. We all know the UK inflation is dominated by pension funds who have inflation liabilities. So it's a difficult market to trade. But I think what's going to happen to the housing markets once price finding happens in the UK, RPI will go down quite a bit. And that is interesting.
Okay, so long tech, long gold, long inflation, those are kind of the three big ones for you. I also wanted to ask you about your process, because I know out of all the investors I meet, whether they're asset managers, hedge funds, you're probably one of the few that has a very rigorous and holistic approach to investing. And it's a bit different to many other people. Often I find lots of funds have one guy at the top. Although technically they have a team, it's not really a team. It's really one person at the top who then delegates everything down. But you have a kind of a different culture. You've structured the team in a slightly different way. Do you want to give us some idea of how you've set your team up and your philosophy of investing and more kind of the process side of things?
Sure. It's a passion of mine. It's something I think about a lot. And probably I've been a rower in the past. And when you row in an 8, it is all about teamwork. And you can have a real top talent in your boat. But if the boat is not in sync, you never will win a regatta. So I think about that a lot. And I think all academic evidence is pointing towards the fact that teams make better decisions than individuals. It's also better for clients, by the way. A staff fund manager or a dictator and on top of the investment process who knows it all and who can talk very well might appeal to some clients because it's a good story to tell. But if you think about it, a team approach makes performance more constant, makes it less prone to sort of managers moving from asset manager to asset manager. If you think about the process and structure a process in a certain way, you start thinking about how can I learn from my mistakes. We talked about that in the beginning, but also how can I continue to do stuff that works and start to decrease stuff that doesn't work. So I think therefore team is really important. Team obviously has a few disadvantages as well. For instance, one of this, if you have a big team, then consensus thinking and group thinking, that becomes a risk. Flexibility becomes a risk as well. If you're a trader, you probably think, well, I cannot, it's horrible if I see a trade and I need to ask my team members what they really think. So it is a balance. In macro world, there's a large risk that you know a little bit of everything, but you're not a specialist in nothing. And that risk you can only mitigate by allowing people to really become experts. And for instance, when Brexit started to become a theme in the market a long, long time ago now, what we said is it doesn't make any sense for the 10 of us, we have 35 people in the team, but let's say for everyone in the team to talk to a few analysts and political commentators and so on. And we all spent some time on Brexit. What we did is we said there's 1 or 2 people in the team which spent all their time on Brexit. And all the specialists which come into the office, they all have their first access is with those 2 people. Because then they become sort of the true experts and they have a way better, deeper understanding of the scenarios possible, the pricing in those scenarios possible. And then we benefited a lot from that. If you then think about how do you mitigate group thinking and how do you create a true meritocracy, is one of the things which I believe in is what we call the Hippo Effect. And it's not because I'm fat, but it is the highest paid person in the room, which I assume I am in my team, but he speaks last. And why is that? That's because it's a group effect that the moment a more junior person who might have a really interesting insight hears the boss of the boss of the boss speak, you create a sort of implicit hurdle for that person to express his views. Because he might think like, well, perhaps the boss disagrees with me. Does that have ramification for me? Or does he might think I'm stupid? So my role in an investment meeting and an investment debate, I see myself way more as a facilitator, trying to make sure that I've got all the views. I then use that broad debate to begin with to identify 2-3 people which have different angles. And then very often we might have a smaller team meeting afterwards where we then even stretch out these different opinions against each other. And then I might even walk away and take a decision outside that meeting. So there is what we try to mitigate is the peer pressure dynamics which you have when you're not an individual trader in front of a screen, but you have multiple people which are participating in the investment process.
How do you deal with difficult superstar people, because in the finance sector, you often have stars or the star culture where there might be a big personality who's been successful. He made a couple of big calls, trades really well, but is very difficult to work with or runs people over in team meetings and so on. How do you deal with somebody who's a top performer on a certain metric, but doesn't behave well in a team setting?
Yeah, that's absolutely a struggle, which I think every manager on the front office of an investment firm, whether it's sell side or buy side, has dealt with that problem successfully or unsuccessfully in his career. That's absolutely true. I'm nuanced in that. On the one hand, you look for super talent. It's my role as the manager to get the real talented people in the team who really can make our clients money. So if the quality is not high enough, you can be a team player, but in the end, if you don't make money, then it still becomes a problem. Having said that, if you don't fit the team and therefore you become destructive for other people, or you don't believe in a process of specialization, and the specialization also means you have to trust other people and you have to delegate true decision-making responsibility to other people as well, even though it might impact the total team P&L in a direct way. And they might take decisions which you not always agree with. If people cannot buy into that team model, and we decide in this team process with me as the final decision maker, but also as the orchestrator of the team, if you cannot buy into that, then in the end, no place in the team. So I have to believe that I can find team players which are top talents. I think I prove that, or I'm happy with the people which I've gathered in the team. But that is the constant gem you're looking for. So for instance, what I do in interviews is I sometimes ask them a list of questions. On the one hand, it's obviously interesting of whether you get 80, 90% or 50% of the questions right, because it says something about how well can people think on their feet and what's the sort of basic knowledge around macro topics and so on. But it's also interesting for someone who perhaps is not in the top 10% of the number of questions that person gets right, but he or she gets different questions right than anyone else. Collectively, we might have a blind spot in a certain area, and suddenly we test someone who sort of answers that question in that area all correctly. That is by itself an interesting person because it creates cognitive diversity.
And how have you found running a team in this lockdown period?
Horrendous. Of course, it's necessary, and especially vulnerable people need to protect themselves. So I get all that. But personally, our team benefits a lot from lots of informal discussions on the desk. And I now realize that those discussions probably happen 50 times a day. And to try to recreate that when everyone is on Zoom or Teams is very, very difficult. To create that creative feet on the table, let's talk about ideas. Nothing is a weird question. Nothing is a out of bounds remark. How do you do that when you cannot see each other? I mean, I occasionally have to talk to my people and say, I've got the impression people are withdrawing again from the discussion. They are becoming less open, which is normal. Because if you don't see each other and you're on the other end of a phone call, it's way more difficult to participate as engaging in a discussion than you would normally do. The other thing I'm worried about is learning. I'm a fan of Malcolm Gladwell, book The Outliers. He says 10,000 hours practice to get brilliant in something. How do I train junior people when they are at home? Someone who sends me a certain overview on a daily basis. His learning point is not making that overview for the 500th time. His learning point is to be in the office and overhear the conversation between senior people when market stress starts to happen. How do people react? What's the dynamic in the meeting? How do we then risk manage that position? What do we do when we are wrong? How do we talk about stop lossing a trade and so on? I would argue his day-to-day work, what he executes, that's not where he learns from. He learns from the other stuff which has happened, overhearing people on the desk. or being called in meetings because suddenly there is a discussion needs to take place. If I need to set up a Zoom call, you have to really constantly start to include people to say, well, this might be an interesting meeting for that person. I'm struggling with that. How do I develop my junior talent when we're in a working from home situation?
No, I agree. I think that's really a good point and a real big challenge. There's so much of this kind of incidental kind of knowledge that gets passed when you just have a random conversation that you have with somebody across the desk where you can ask them a question. Yeah, it's something, at Macro Hive, we've been thinking about this a lot as well. I mean, because we're a startup, we're a bit more sort of digital native in the sense that our sort of infrastructure is very in the cloud and many people already work from home anyway. So it's a bit easier. But even so, there's nothing that beats the office interaction because we also have an office as well. And when we moved into our office, you could suddenly see just the engagement jump up. And you notice it the most, you're right, with the juniors. At the moment, we kind of have 3 or 4 times a week, a 1-hour call where we talk about any issues or things that the junior guys in the team want to learn. But that's very structured, and it's not the way I learn, for example, and I don't think it's the way most people learn. It's those unstructured interactions, and you're right. This is going to be one of the things that you need to appreciate about being in an office together.
I see myself, my own leadership position as someone who facilitates the leader of an orchestra. It also means at the moment I'm spending probably 30% of my time on a daily basis coordinating between different parts of the firm. As I say, in macro, I need to keep contact with the equity team. I need to be in contact with the fixed income team and so on, because there might be bottom-up information which becomes relevant for macro as well. And so there's so much time I'm now having to do on coordination, where if you're on a big investment floor, it's way easier to access that information. I think, for instance, part of the sell-off we saw in March was also basically risk budgets of trading desks being decreased because everyone starts to work from home. And then you are out of the information flow. So why wouldn't you decrease risk?
Okay, well, I think we've had a fantastic conversation. I'm sure we could talk for much, much longer. One thing I did want to ask you, Emiel, is, is there a way for people to follow your thoughts or your thinking in any way?
Yeah, the asset allocation team of Elgin has been blogging for years now. The blog is on the www.elginblog.com. If you're only interested in the asset allocation IDs or macro IDs, then you sort of sign up for the asset allocation part of that blog. And then obviously my name is on there as one of the authors. You could even fine tune it towards my own blogs. Yeah, we as a team, we blog on many, many macro issues, about 2 or 3 views a week out, and we are not shy of explaining what we do in portfolios and why. So
I'm a big fan of the blog, by the way, so I can read it. That's whenever it comes out. For the listeners, we'll include the link to the blog on the show notes to the podcast, so people can click on that to follow it. Well, on that note, thanks a lot, Emiel, and good luck for investing for the year ahead, and hopefully we can catch up soon in person. Thanks for listening to this episode. Please subscribe to the podcast show on Apple, Spotify, or wherever you listen to podcasts. Leave a rating and let other people know about the show. Also, sign up to become a subscriber to our research at macrohive.com. We'll be back soon, so tune in then.